Welcome to the deep dive. Today, we're plunging into something potentially massive for one of India's biggest companies. Imagine this. What if a proposed tax change could seriously shake up the profits, maybe even how people buy things, and yeah, the stock price of a company that's basically a household name across India? We're unpacking a really fascinating development involving, well, the cigarette giant ITC, and this proposed 40% GST on tobacco. Our mission for you today is simple. Cut through the noise, look at the key developments, and try to figure out what this could really mean.
It's definitely a critical topic. Tax policies, especially for something like tobacco, they can have profound impacts even on huge established industries like this one.
Absolutely.
So we'll explore not just the what is happening, but really the why it matters for the industry, for ITC, and maybe for how you see these market forces playing out.
Okay, let's dive right in then. The core idea. India's biggest cigarette maker, ITC, facing this potentially huge change. Now, ITC, they started way back, 1910, as the Imperial Tobacco Company. And yeah, they've diversified like crazy: FMCG goods, hotels, paper, agri, IT. But still, cigarettes bring in, what, 70 to 75% of their profits?
That's right. It's the absolute core of their financial strength. And what's really crucial here is their dominance. They hold over 80% of the legitimate cigarette market in India. That's huge.
50%. Wow.
Yeah. Brands everyone knows: Gold Flake, Classic, Navy Cut, Bristol, India Kings, you name it. So this massive market share means any tax change, even a small tweak, hits ITC harder than anyone else.
Right, makes sense.
So, if you're looking at ITC, you really have to see it as, well, fundamentally, a tobacco company wrapped up in other businesses. The goose laying those golden eggs. Still cigarettes.
And that golden goose is now facing this potential 40% GST threat.
Okay.
That sets the stage nicely. But before we get to the new proposal, maybe we should touch on the current tax situation, because it's not simple, right?
Oh, far from it. It's quite a maze, actually. To understand the potential impact, you absolutely need to grasp the existing layers.
Okay, so break it down for us. What are cigarettes taxed on right now?
All right. First, you've got the standard 28% GST. That's the highest slab, reserved for luxury or demerit goods, as they call them.
Okay, 28%.
Then comes the real killer.
Okay.
The compensation cess. This isn't just a simple percentage. It has two parts. There's an ad valorem part, which is a percentage of the value, and a specific component, which is a fixed amount per cigarette stick, varying by length.
Wow, okay. Complicated already.
And it doesn't stop there. You've also got the NCCD, the National Calamity Contingent Duty. That actually went up in 2023.
Right, I remember that.
And believe it or not, there's still a tiny leftover basic excise duty, just sheer 5 per 1,000 sticks, but it's still there.
So multiple layers: GST, cess with two parts, NCCD, even a bit of excise.
Exactly. Put it all together,
Yeah.
and you're looking at taxes making up more than 50%, sometimes significantly more, of the final retail price of a cigarette pack.
Over half the price is just tax.
Pretty much. And if you connect this to the bigger picture, you see why. The government relies heavily on revenue from tobacco taxes. That's why these taxes tend to creep up almost every budget cycle. It's a reliable source of funds.
So ITC is basically acting like a tax collector for the government in a way.
In essence, yes. Every cigarette it sells is partly revenue for ITC and partly revenue for the state, a very significant part.
Okay, so given that incredibly complex and heavy tax burden, how has ITC's cigarette business actually been performing recently, before this new 40% GST idea surfaced?
Good question. Let's look at the numbers, say, for Q1 of fiscal year 26. The net revenue for the cigarette segment that's excluding excise duty was around 8,520 crore.
And how does that compare?
That was up 7.7% compared to the same quarter the previous year. Pretty healthy. Some reports even mentioned a higher gross revenue figure, around 9,554 crore, which points towards double-digit growth overall for the segment.
Double-digit growth even with those taxes. And volumes.
That was the interesting part. Volume growth was estimated somewhere in the 6 to 7% range, which was actually the highest it had been in several quarters. So demand was quite robust.
Okay, strong top-line growth. But what about profits? Did that translate directly?
Well, that's where there's a bit more nuance. Segment profits, the EBIT, came in around 5,145 crore. That was an increase, yes, but only 3.7% year on year.
Ah, so profit growth lagged revenue growth. Why?
Margins were under a bit of pressure. EBIT margins actually compressed. They were down about 220 basis points. That's 2.2 percentage points compared to the year before. The main reason cited was holding higher cost leaf tobacco inventory. Input costs were biting.
I see. So rising costs squeeze the margins despite good sales.
Exactly. But the outlook provided at the time suggested that improvements in procurement costs were expected. So the expectation was that margins would likely recover. Shows that constant balancing act,
Yeah.
managing demand, input costs, all under this heavy tax structure.
Right. Okay, so strong performance, but with some margin pressure. Now, let's get to the main event. This is where it gets really interesting, potentially disruptive. The Independence Day 2025 speech. PM Modi announces these next-gen GST reforms.
Yeah, that certainly caught everyone's attention.
The plan, as announced, was to simplify the whole GST system. Get it down to two main slabs, just 5% and 18%. Sounds simple enough.
Right. It seems like a simplification.
But, and this is the huge but, the plan also included creating a special high slab, 40%, specifically for sin goods like tobacco.
And that is a major, major departure. Remember, tobacco was sitting at 28% GST plus all those cesses and duties.
Exactly. So the immediate question, the big ambiguity that hit the market was, okay, what does this 40% mean?
Precisely. Does the 40% just replace the current 28% GST base rate with maybe adjustments to the cess? Or does this 40% somehow stack on top of the existing cess structure or replace everything?
And the answer to that changes everything for ITC, doesn't it?
Fundamentally. It's the difference between a manageable, though painful, adjustment and potentially a massive, unprecedented blow to their core business. This ambiguity is really the crux of the issue, and it sets up basically three possible futures, three scenarios we need to unpack.
Okay, let's walk through these what-if scenarios because, the implications are wildly different. Scenario A, let's call it the swap. What happens here?
In this scenario, the thinking is that the new 40% GST rate simply replaces the old 28% GST rate. And crucially, the compensation cess would likely be reduced or adjusted downwards to accommodate the higher base rate, keeping the overall tax burden somewhat similar or maybe slightly higher.
Okay, so a swap, maybe a slight overall increase. What's the effect on ITC?
Well, they'd almost certainly have to raise prices to cover that higher 40% base rate. You'd expect volumes to dip in the short term. Smokers react to price hikes, maybe cut back initially. But over time, margins would likely stabilize as they adjust pricing and volumes recover somewhat. So it's painful, yes, but probably survivable for a company like ITC.
Right. Painful but survivable. Okay, investor takeaway for scenario A.
Temporary bump. Expect some stock volatility on the news, but historically, ITC adapts to these things. It wouldn't necessarily break the long-term investment case, though it would dent near-term earnings.
Got it. Now, scenario B, you call this one the double whammy. Sounds bad.
This is the nightmare scenario for ITC and its investors. Here, the 40% GST is levied, and the existing compensation cess structure continues largely unchanged on top of it.
Oh, wow. So 40% plus the cess.
Exactly. If that happens, the total tax incidence on cigarettes could shoot up dramatically. We could be talking about retail prices jumping, 20%, 30%, or even more, almost overnight.
What would that do?
Historically, shocks that large push consumers very quickly towards cheaper options. And also that means illicit, smuggled, or counterfeit cigarettes, which are already a big problem in India. This could seriously eat into ITC's legitimate sales volumes and hammer their profits, their EBIT.
So a major hit to volume and profit. Investor takeaway.
If scenario B looks likely, brace for impact, serious stock volatility, and analysts would have to fundamentally reevaluate ITC's earnings power and maybe its dividend capacity. It's the real danger zone.
Okay, nightmare scenario noted. Then there's scenario C. You called this the miracle.
Chuckle slightly.
Yeah.
Perhaps a bit optimistically named. In this scenario, the 40% GST rate comes in and replaces everything else. The 28% GST, the compensation cess, the NCCD, all gone. Just a single 40% tax.
So 40% replaces the current 50% plus effective rate.
Potentially, yes. If the 40% all-in rate is actually lower than the current combined burden of GST plus cess plus NCCD, then the effective tax incidence could fall.
And that would mean?
It's the dream outcome for ITC. They could potentially keep retail prices the same, maybe even lower them strategically, and pocket significantly higher margins. Or pass some savings to consumers to boost volumes. Massive profit expansion potential.
But you called it a miracle. Why is it so unlikely?
Well, politically, it's very difficult to see any government wanting to be perceived as reducing the tax burden on cigarettes. The public health argument, the sin tax justification, it all points towards maintaining or increasing taxes, not decreasing them. Governments need the revenue, and taxing tobacco is generally popular, or at least not unpopular.
Right, bad optics to cut taxes on cigarettes.
Exactly. So while it's a theoretical possibility based on the wording, it's not something you'd want to bet your investment thesis on. The political reality makes it highly improbable.
Okay, so 3 scenarios. Swap, painful but survivable. Double whammy, potential disaster. And miracle, highly unlikely dream.
Now let's talk about ITC's history. Haven't they faced big tax hikes before? How have they usually coped?
They absolutely have. Tax hikes on tobacco are almost an annual ritual in India, it feels like sometimes. And historically, ITC's playbook has been quite consistent.
Yeah.
Pass it on, they raise prices to cover the increased tax
Why
burden.
do consumers just pay up? Well, there's usually an initial reaction. Volumes dip for a bit, maybe a quarter or two, as people adjust or try to cut back. But cigarettes are addictive. Demand is what economists call relatively inelastic, especially over the medium term. People tend to come back. Volumes recover.
So history suggests resilience.
To a point, yes.
Yeah.
But there's a counterargument, a real risk we touched on, with scenario B, the illicit market. If legitimate prices rise too much too quickly, it makes smuggled and counterfeit cigarettes much more attractive. That hurts ITC's volumes, and it also hurts the government tax collection. So there's a limit.
It's a balancing act for the government, too, then. Tax too high, and revenues might actually fall.
Precisely. But ITC does have another card to play, a kind of safety net. It's diversification.
Right, the FMCG, hotels, paper, all that.
While cigarettes are still the profit engine, ITC isn't just a cigarette company anymore. Think Ashir, Bingo Chips, Sunfeast Biscuits, Savlon. These are big brands. Those other businesses, FMCG. Others, hotels, paperboards, agri, now contribute over 40% of ITC's total revenue.
Is that enough, though? Enough to cushion a major blow to the tobacco side?
That's the million-dollar question, really. Is the growth in those diversified segments fast enough to offset a significant, sustained hit to cigarette profits if, say, scenario B played out? Probably not entirely, not yet. But it provides some cushion and, importantly, a future growth story beyond tobacco.
And how does the stock market typically react?
Usually you see a knee-jerk negative reaction when big tax hike news hits ITC. The stock often dips. But then quite often, once the actual financial results come out and show the company is managing, that resilience kicks in and the stock tends to recover.
So the punchline seems to be 40% GST news might cause short-term fear, but history suggests ITC finds a way to adapt.
Largely, yes. They have a track record of navigating these challenges. Whether this particular change, depending on which scenario unfolds, is bigger than what they've handled before. That remains to be seen.
Okay, let's just quickly summarize the key risks again, besides the immediate price shock.
Sure. The biggest underlying risk is that if the total tax becomes too high, it fuels the illicit trade. That's bad for ITC, bad for the government.
Loss of volume to the gray market.
Exactly. And the second risk is downtrading. Even within the legitimate market, if prices go up a lot, smokers might shift from premium brands like Classic or Goldflake down to cheaper brands.
Yeah.
Since premium brands usually have higher margins for ITC, this downtrading can squeeze profitability, even if overall volumes don't fall dramatically.
Right. Affects the profit mix. And the safeguards. We mentioned diversification.
Diversification is key for the long term, gradually reducing reliance on tobacco. It's happening, but it takes time. But arguably, their biggest current safeguard is simply their massive market leadership. That 80% plus share gives them incredible pricing power.
They can dictate prices more easily.
More easily than smaller players, certainly. They have the scale, the brand loyalty, the distribution network. They can absorb and pass on tax hikes more efficiently than competitors. It makes them inherently more resilient to these kinds of shocks.
Okay, so bringing it all together for someone maybe looking at this from an investment angle, why is ITC watched so closely?
Well, for years, ITC has been known as a solid, reliable, high dividend-paying stock, almost like a bond proxy for some investors in India. That dividend is largely funded by the massive profits from the cigarette business.
So any threat to those cigarette profits is a direct threat to the dividend and the stock's valuation.
Exactly. It hits the core investment thesis for many holders. It affects profits, dividends, and ultimately how the market values the company. It's fundamental.
So the final takeaway for investors listening,
I'd say, expect short-term volatility if and when details of this 40% GST emerge. The market hates uncertainty, especially around ITC's golden goose. But looking longer term, ITC's history shows remarkable resilience. They operate in this really unique, kind of contradictory space. Well, think about it. The government needs tax revenue, and tobacco is a huge source. Smokers, despite health warnings and taxes, continue to demand cigarettes. And ITC is stuck right in the middle, efficiently collecting taxes for the government, while simultaneously generating massive profits for its shareholders from that same activity. It's a tax collector and a profit machine rolled into one.
A strange position to be in.
It really is. And it leads to that final provocative question for you, the listener, to think about. Do you believe this proposed 40% GST, depending on how it's implemented, will finally be the thing that breaks ITC's long-held cigarette dominance? Or will they adapt, adjust, maybe shrink slightly, but remain resilient and ultimately prove unstoppable once again?
A fascinating question indeed. Thank you for joining us on this deep dive into what's undeniably a complex and really significant issue for one of India's corporate giants. We hope this gave you some clarity and things to consider about ITC, the potential GST changes, and the wider market implications. Do reflect on that final question.
And just a crucial reminder before we sign off, we are not SEBI-registered financial advisors. This discussion was for informational purposes only. That's right. If you are considering making any investment decisions based on this or anything else, please consult with a certified financial advisor who understands your personal situation.